Let's talk about VOO and VTI. What's the difference between these two Vanguard ETFs? We're going to take a look at their portfolio composition, their Morningstar stock style, their historical return performance, their volatility, and talk about which one you should invest in. Here we go. So VOO is Vanguard's S&P 500 ETF, which seeks to track the S&P 500 and has an expense ratio of 0.03% or 3 bips. VTI is Vanguard's total US stock market ETF, which also has an expense ratio extremely cheap at the same 3 bips. The big difference between the two here is that the VOO ETF tracks the S&P 500 index, while VTI seeks to represent the total US stock market of all publicly traded and liquid securities. So from that, the portfolio composition of the two is a little bit different. VTI here is going to hold about 4,000 holdings in it because it's got to hold the total US stock market, whereas at 4,149, whereas VOO is only going to hold about 500. So while it's called the S&P 500, there isn't exactly 500 stocks in it. It could be more, it could be less, but it's going to be pretty damn close to 500. Let's see what it is. 512 holdings. So you get more diversification, or you hold more stocks with VTI, 4,000, right? Because it's holding the total US stock market. Now with that, it does look a little bit different. The portfolio composition does look a little different. If we look at the Morningstar stock style here, we will see that the Vanguard Total Stock Market ETF dips way lower into small cap territory. So this is showing how much exposure it has to small, medium, and large cap stocks, and then value, blend, and growth, right? Right here, it is dipping into, or by this chart, it's showing that it's dipping into small cap territory and holding some small caps. If we go to the S&P 500, we'll notice on this chart, it's pretty much up here in the large cap, kind of has some exposure to mid caps as well, but most of its exposure is to large caps. Naturally, the S&P 500 is a large cap index, so it doesn't hold many small, or probably doesn't hold any small cap stocks. And it doesn't really hold many mid-cap stocks. I think the S&P 500 does hold some stocks that have a market cap of $1 billion or $1.5 billion. So they're technically a small cap, but the weighting to them is going to be much, much less. And we can see that reflected here on the Morningstar stock style chart. It's important to take that away. The S&P 500 VOO ETF really doesn't come down into the small cap territory or capture much mid-cap, right? Whereas VTI does. It gets much more exposure to small caps. Now, when we look at the portfolio here, the top 10 holdings of them are probably going to be the same. So in VTI, we can see the top 10 holdings: Apple, Microsoft, Amazon, Tesla, Alphabet, NVIDIA, also Alphabet, Meta, which is Facebook, Berkshire, JP Morgan. It's probably going to be the same for the S&P 500. Actually, no, it's going to be the same. Yeah, the top 10 holdings are the same, but notice the weightings of the top 3 holdings. Let's just look at those. Apple, 6.67%, 6.39%, 3.93%. When you look at VTI, it's going to be a little bit less, right? And again, that's because it's got so many more stocks, and it's got to comprise itself of the total US stock market, including all of the small and mid caps. So it's giving them some exposure. They represent more of the total index, or more of the total US market than they get represented for in the S&P 500, which basically just holds 500 large cap stocks, whereas in VTI, there are going to be probably a couple thousand small and mid cap stocks in here that get weighting. So they're taking away weighting from the larger cap stocks. So again, this basically reflects what the stock style charts were showing us here. VTI gets exposure to the small cap market. Now, how has these two funds performed, right? Well, so in Portfolio Visualizer, I pulled them up here and I used asset classes with US stock market being VTI and then Vanguard's 500 index investor being VOO to represent us. Because of this, we can go back to 1977. If we just use the actual ETFs and not the underlying asset classes, we would not get data back to 1977. But you can see over this time period, they've performed pretty damn similarly. US stock market 11.74%, a little bit more than the S&P 500, 11.63%. Why is that? Well, again, it's probably the exposure to small caps. In academia, there is a risk premium associated with small caps, and that is broadly saying small caps do better than large caps, and that is being reflected here in these two portfolios. That's probably why the US stock market portfolio has slightly outperformed. But again, you have to consider the Vanguard's or any total stock market portfolio is going to be heavily weighted towards large cap, so it's really not capturing that small cap premium. Now on volatility, that's where there's going to be some difference between the two of them. If we come back here to Morningstar and go to the risk tab and wait for it to load, we can see the standard deviation of VTI 18.17, and with the S&P 500, it's probably going to be a little bit less. Tick-tock, it's loading. Yeah, it's less. 17.42. Right, so it's a little less, not a lot less, but again, that has to do with the inclusion of small caps in VTI in the total stock market. Small caps are more volatile than large caps. Therefore, the standard deviation of VTI is going to be a little bit higher than the S&P 500, which does not have any exposure, much exposure to the small and mid-cap markets. So which one should you invest in? Because they're very similar. Taking a look at the historical returns, we can see they're very similar and there's really not a huge difference. Well, my philosophy on that is, if you're just trying to do a simple portfolio, like a simple 3-fund portfolio of bonds, stocks, and foreign equities, and not break things up, you just want a simple 3-fund portfolio, you would be best served with VTI, the total stock market ETF, and get exposure for that. If you're trying to go a little bit more complex and trying to get more exposure to different asset classes, right, and have like a 7 or 10 fund portfolio and control your exposure to each asset class, you would probably want to go with VOO and use that to represent your holding of large blend, because the S&P 500, it does at the moment cater itself more towards growth, but where is it here? If we go to portfolio and look at the stock style, right now it's leaning more towards the growth side of things, but if valuations go down, in the large cap asset class specifically, it could kind of cater itself more to value, but it is really a large blend holding, or a large blend portfolio, or a large blend ETF, however you want to slice and dice and say that. It gives you exposure, to the blended large cap market. So if you're breaking your portfolio up and trying to segment and control what exposure you get to each asset class, the S&P 500 would be the ticket you'd want to use to get exposure to large caps. Now, alternatively, one thing I think that's an honorable mention here, and this is a little bit different than VOO and VTI, is an equal weight S&P 500. Equal weighting the S&P 500 is going to get you more exposure to the small and mid-cap stocks. And over time, it is probably, this varies over the time period you're looking at it, over time it has probably outperformed the S&P 500 a little bit. Let's just put it on here and click max. And then put S&P 500 on there, as represented by Vanguard's mutual fund for the S&P 500. And yeah, you can see that RSP, the equal weighted S&P 500 by Invesco, has actually outperformed the S&P 500. And again, this is probably capturing some of that small and mid-cap premium. So VOO and VTI, that's the difference, and that's my opinion on which one of them you should invest in, along with a little bit of anecdotal comparison on RSP. Which one are you guys going to invest in? Let me know in the comments below.